AGF, what are you doing after work?
David Burrows is here from Barometer Capital Management, and Larry's in Burnaby, BC. Good morning, Larry.
Good morning, gentlemen.
Welcome.
David, can you please give me your view on research in motion and take into consideration its value for its current patents and other assets, please? Thank you.
Sure. So, Larry, I'm going to look at RIM through the lenses that I look at, and you have to make your assumptions around that because we really are not value investors. Those that look at the company and say, what's the sum of the parts worth if it were broken up and sold off? There are people better suited to make that analysis than we are. The problem we find is that very often, and we take care of private investors, people have only so much patience. Mm-hmm. You have to be very patient as a long-term value investor to ultimately get your money. So Prem Watsa probably is better to answer that question than I am. But the way we look at things is that yes, is RIM some of the parts worth more than what it's trading for now? Yes, possibly. But they have a quickly deteriorating business, and they're in a space that has become very, very competitive and showing no signs that that's letting up. I found historically, being a value investor in technology, if not having to be very patient, it can be somewhat worse than that. You can lose a bunch of money.
And I can imagine as well it's difficult to even determine what value is. This whole patent portfolio issue, as Larry points out, how do you genuinely know what the value is of certain patents?
Right.
A lot of the technology that Research in Motion is using was fabulous back in the day, right. But does anybody want to buy that technology today?
Well, things are changing very, very rapidly, and when you wind up behind the curve, it can be very, very hard to catch up. So I'm going to give the same answer I've been giving since about $70. The stock has deteriorating fundamental characteristics. The price characteristics support that view. Mm-hmm. In other words, price behavior is acting like the fundamentals, and trying to pick up dimes in front of a bulldozer in a really long downtrend like that, I think, is very difficult. So it's something I would stay away from.
All right, there's an image for you. Thank you, Larry, for that. We're off to Toronto now on the local line. Hi, John. Thanks for holding.
Hi, I'm John from Toronto.
Welcome.
And I'd like Mr. Burrows' opinion on Brookfield Infrastructure, the long term, and I think they reported their earnings. I wonder if you can comment on that.
Sure. John, Brookfield Infrastructure is a company that we quite like. So we're investors in Brookfield Asset Management as a parent, mm-hmm. and I think that they've been very smart in taking the various pieces of the business and creating pure silos to allow investors to assess their interest in investing in each of those business lines. They have basically, Brookfield Asset Management built a business managing assets with long life cash flows attached to them. These become alternatives to institutions to investing in long-term bonds. And they get valued against a long-term bond. So there's an expected spread of return better than a long-term bond. Brookfield Infrastructure has shown a great ability to identify investment targets. And because they've done a good job for their investors, in the event that they need capital to grow that unit, mm-hmm. they can come to market and raise it very effectively. They've got a very strong payout to their investors, so they're basically showing a willingness to return distributions to mm-hmm. their investors, and I think that this falls right in the heart of the key theme in this marketplace, which is predictability. They appear to be able to find assets internationally that give them very good returns on capital, and with a modest amount of leverage, give a good return on equity. So this is a unit I would be very happy to own.
Yeah, I've just been doing some preliminary research here as you were answering there, and it's got a 4.2% dividend yield, 37.5 cents. Its beta is less than half of that of the TSX, so it's half the volatility.
Right.
Q2, the funds from operations came in at 60 cents, beat the street by 2 cents, and their payout ratio is 63%, which is within that 60 to 70% range.
That's right. So this fits right within the sweet spot of the market that we're in, and this is the type of investment we like to make in our client accounts.
But again, you own the parent company versus this one.
We own the parent company as it stands right now, but I would have no problem owning the infrastructure piece.
All right, John, thanks for the call from Toronto. Dave in Saskatoon, thanks for holding. Welcome to Market Call.
For taking my call.
Mm-hmm.
My question is regarding BHP for long-term holding. Thank you very much.
All right,
sure.
Thank you. What's long-term to you?
Well, we'd like it to be years, like in the event of a BCE, mm-hmm. But it's dependent on the investment's ability to meet the hurdles, and we're looking for improving or accelerating fundamentals and price behavior that supports that view. So the problem that we face right now with any of these metals companies is that over the last number of years, they've performed very well, but over the last 18 months, in general, you've seen a series of lower lows and lower highs in price, and you've seen decelerating earnings and revenue lines. You have to remember there's a reason why these companies historically have been called cyclical. When they look really inexpensive and their earnings are great, very often it means that you're going to see new capacity come online. Now, through the early part of this decade, these companies were very disciplined around not over-investing in capacity. And all through that period, Chinese demand grew and emerging markets demand grew and so on. In the next couple of years, there's about $200 billion worth of expansion projects come online in the basic materials industry. At the same time as we're seeing deteriorating fundamentals in Asia. Now, that may be short-term by nature, it may be something longer. In the meantime, you've got weak demand and you've got new supply coming on, so that risk-reward isn't great. And it may be that that's completely discounted, but the way that the shares are behaving in most of these companies, you're getting short-term rallies and longer-term declines. So again, it's a group that we would be cautious about unless you are anything other than a really nimble short-term trader who's able to make an exit in a hurry.
Dave, there's your answer. Thanks for the call from Saskatoon. A quick break. David Burrows is our guest. He's the president of Barometer Capital Management. We're talking North American large caps. And when we come back, the past picks. Since he was on August 18th, he's up more than 14%. We'll show you why when we come back.